Welcome back to the Make It Count podcast.
I'm Marcus Mire, founder of Mire Group CPAs and the Total Control Accounting System.
And I'm Tyler Warner, small business owner with a lot of accounting questions.
All right.
Today, we're talking about cash flow.
What do you, is that a question? You said small business owner with a lot of accounting questions. You got questions?
I do. How do we make more cash flow?
How do we make cash flow?
Yeah.
No, it's a great question. And you always hear this, right? Like cash flow is the lifeblood of a business. And then you hear CPAs, I see them on LinkedIn and Twitter, like, hey, cash flow, and they have the little equal sign or with the slash through it does not equal profit. So I think there's a lot of just confusion about, cash flow is what will put you, which will make your business or break it, right? If you don't, if you can't bring in more cash than you spend, right? Then you go out of business. It's just a matter of time. So just want to kind of unpack some of the things. I want to bridge the gap between profitability and cash flow. I think that's important. But just also give some people some things to think about. They're not as complicated as they sound. It's got a lot of it goes back to like Dave Ramsey always says, like, do like your grandmother says, make a budget, live on less than you make. Like those old tried and true things. Yeah. Like a lot of this stuff I think is going to come from that kind of
better than you deserve.
That's right. That's right. That's right. Live like no one else so you can live like no one else.
Yeah.
Is what he says.
Yeah, something like that.
I think
he's just always like, oh, how you doing? Oh, I'm better than I deserve.
Better than I deserve. That's
right.
what he says in that old Tennessee drawl.
Yeah.
All right. So what I would say kind of as you're thinking through cash flow and what that looks like, let's start to unpack the differences between profitability and cash flow. Okay. So biggest thing that comes to mind when people are thinking cash flow and profitability is paying back debt and or taking money out as a business owner or paying back investors. So, and you've mentioned this before, like, oh, I wish they need to change those accounting rules. How excuse me. When you pay back a loan, well, first of all, when you borrow money, that's not income. When you pay it back, that's not an expense. So that's the first thing to think about, is that your P&L right then and there doesn't tell the whole story, right? You could be profitable, but paying back debt. So perfect example would be we borrowed money to start this business, and now we make $100,000 of profit, but we have to pay back 20 grand on the debt, right? The principal payments on the debt for the year are 20 grand. Because in that example, the interest would be on the P&L. It's included in that 100 net. So from a cash flow perspective, you have 80 grand to play with.
Okay.
Or even make the example bigger. Let's say you borrowed a lot of money and you had to pay back $50,000 of principal. In that example, you only have 50 grand of cash, but you have 100 grand of profit. So how can that be? The reason is because you use your profits to pay down debts. Does that make sense? Or you use your profits to pay back owners in the form of distributions or return of capital. That's the first thing I want people to understand, is that profitability is a very good indicator, right? Most profitable businesses don't go out of business. But you have to maintain this understanding of profitability, then cash flow, meaning, okay, the 100 grand, you used to do this. I always reference how you used to do this in the business that you owned about 7-8 years ago. You guys just did a very simple cash flow forecast. Here's what we're going to collect over the next 2 weeks. This is what we have to spend. It's very simple. So the first thing is...
And brilliant.
All at the same time.
Yeah. I mean,
if you must say so. So I think people just need to understand that first principle. There are things that happen in a cash flow perspective that aren't in profitability. Right. Profitability is what you used to manage cash flow. Because if you're not profitable, ultimately, the money will dwindle.
Yeah, I think there's a couple things, like I've only owned really like kind of small, simple businesses.
Right.
Where cash flow was really more, it was just a helpful tool to make sure that we kept operating.
Yeah.
But it sounds like there's more nuance, or there's more to it than just that. You know what I mean? So like, while we always knew, okay, here's what's coming down the pipeline compared to the expenses, it was just kind of future projection. It was almost just like a way to like generate a future P&L.
Correct.
Is really all we were kind of doing.
Basically a cash statement, a cash flow statement, right?
Right.
Is what you guys were doing. Yeah.
Right.
Yeah. What I would say is this: profitability ultimately tells you profitability combined with cash flow kind of gives you an idea that, hey, we're going to need to borrow money, or that this business is worth borrowing money for.
Mm-hmm.
A perfect example is, and we'll get into some ways to mitigate this, but this is a lot of businesses. A lot of businesses pay their employees, their subcontractors, before they get paid. Very common, right?
Yeah, sure.
Obviously, you pay your employees. So, hey, I got to pay my employees and I pay my contractors, but I don't get paid by my customer for 30, 60 days. Well, if the math says that what you build is greater than what you paid the contractors, employees, and all your overhead, well, ultimately, you're going to be cash flow positive. Mm-hmm. But in the short run, you might have some borrowing requirements. You can basically say, well, I'm going to get that money. That's what profitability means. Profitability means ultimately I have a right, or I will have this money. Mm-hmm. I just maybe don't have it now. Like, profitability speaks to what your cash flow will be. But that's when you would say, well, I know with a very simple forecast, man, we're going to pay out 50 grand of subcontractors. Now, we build them out for 200 grand, but we don't get paid that 200 for a month.
Yeah.
And we don't have enough cash in the bank to pay the 50. We got 20 grand in the bank right now. Mm-hmm. So let's borrow 70, 80 grand, pay that, knowing that we're going to get 200 to be able to pay this loan back easily. Mm-hmm. And that's why you hear people managing things with debt that way, is because the profitability is telling them they can borrow money. In that example, they know they're going to make 150 grand. They just don't know the timing when it's going to be in their pocket. Mm-hmm. And so that's why I always say you got to bridge the gap between the two. You got to have profitability. It tells you, hey, I'm going to have this cash. And then you can go make decisions around debt. Like, I hear people factor invoices. We have a client here, we tell to do that. Factoring invoices is essentially where you sell an invoice. Like, you get 100 grand owed to you by a customer. There are businesses that'll come in and say, listen, I'll give you $97,000 right now, and I'll go collect on it. Well, why would you do that? Well, the reason people do that is because of cash flow. Right? They want to be able, they think that that's a worthy expense to get the money now. But what we're starting to tell our customers is, let's do a little more nuanced cash flow projection to see if it's worth paying them 3 cents, or could we, because $3,000 in that example, if you did the math on the interest rates, it's ridiculous because it's a short term, right? It sounds like it's 3%, but it's 3% over 2 weeks. It's a short, very expensive loan. Cash flow would tell us, why don't we just go get a line of credit at the bank? Pay them 8%, right? Because ultimately we're going to have this money in 60 days. Let's just get the line of credit to fund it. Mm-hmm. So that's where the nuances of cash flow and understanding profitability can kind of come together, where you can make some good decisions where, it seems like 3%, but it's really like 25% interest versus 8% on a revolving line of credit.
Yeah.
That's the kind of nuance we want our clients to get to. Yeah. Those little, what I would call them, base hits, that those things add up. What do people that don't run their business well, they don't understand that stuff, it's too expensive to hire CPAs or good advisors, they factor the invoice. And I'm not saying that's always a bad idea. What I'm saying is there's nuanced answers, and they're dictated by cash flow and profitability.
So you mentioned you recommend factoring. You mean you recommend the line of credit?
Correct. What I mean is, and if I said that, I'm mistaken. I've said we have recommended it to clients. Oh, okay. I'm saying it's a tool in the arsenal.
Gotcha.
Like, maybe they're unbankable, new client, new business, can't get a big line of credit. But man, as you get started, ultimately that credit worthiness builds and you can borrow. I'm looking at you as you said that. I wanted to make my next point. Now I can't think of it.
Okay. Well, we were talking about cash flow, obviously, but specifically, like, what are the other benefits of understanding your cash flow besides just knowing? Like, I'm thinking of back in the office when me and another guy we weren't necessarily partners, but we shared a lot of mutual clients, and like he had designed his cash flow. I think it was just a spreadsheet, but like he had built like another little tool that was just like how many more days he could be in business, basically, until the money ran out.
Yeah, right.
Which, that's a real startup, like just basically like his burn rate, how much cash he was burning through,
yep.
And it would be like every day, like, okay, well, we've got 60 more days in business, or we've got 83 more days in business,
Yeah. And I think too, I mean, you're kind of getting in kind of the SaaS startup world of burn rate. And I think too, ultimately, if you're, if you're looking at it that way, you are always in a position where you're losing money, and you're thinking, can I buy enough time with borrowed money and investor money that it will turn profitable and the cash flow will ultimately flip back, right? Because a burn rate is just that. If you have a burn rate, it means you're spending more than you got. Like it means you're spending more than you're taking in currently.
Sure.
And then we're just measuring, okay, very simply, we got $1 million in the bank. Our burn rate's 10 grand a month. We got 100 months. I mean, that's pretty simple. That's, so lots of people do that. What I would say is, so we've talked a lot about like cash flow and debt. What I would say, what are some things you can do better with cash flow? And this is, I'll give you some pointers. So the first thing what I mentioned earlier was just understanding where debt plays the role. Understanding where you're profitable and you can borrow money to bridge gaps, and then you start shopping debt for cheaper interest rates because it just means more money in your pocket. If you can ultimately pay it back, in that example I gave, we could, then we shop debt lenders and try to get the best rate. Another thing I would say is, to avoid that, think about how your revenue cycle is. Are you a 60 days to get a product out the door or a service out the door, ultimately coupled with another 60 or 90 days to collect? Like, that's tough. Think about deposits. Are there ways you can do progress billing, milestone? A lot of people do milestone billings. Like if you work with architecture firms or advertising, they'll say, look, we want 30% upon this level of drawings, 60% when they put the roof on. Like these different milestones. Like think through how you can get paid in tandem with the money going out the door. Because if not, you're always going to be in this kind of crunch of, well, I had to lay the money out first to get paid for it much later. And now I'm managing this debt burden, or owners are having to put up money ultimately to get it back. But you could do better. So I would say rethink your revenue cycle. How do you get paid? How do you bill people? Are there ways to speed that up and match cash inflow with cash outflow?
Gotcha. Okay. Yeah, I mean, that could be that in itself. I mean, even we've talked about this before, just taking credit card fees.
Correct.
Yeah.
Yeah. Credit card fees get, it's kind of one of my hobby horses, it's kind of that example I gave you on the factoring. It's like sometimes 98 cents on the dollar today is worth it. Sometimes it's not, So, but for a lot of businesses, I think what the credit card fee represents, I would look at it in a different way. The 3% I'm paying, it's not a apples and oranges discussion on the factoring, like I just mentioned. For me, the credit card expense represents something I also didn't have to do. I didn't have to have a person in collections. I didn't have to have a person handling, sending out bills. I can automate that process. And so, yeah, maybe I'm willing to give up 2 or 3%, but it's because I didn't have to have a person who cost me way more potentially than that 2 or 3%. So that's another kind of way I look at it from the credit card perspective.
Yeah. Who's looking at the cash flow and like, what does it take to get set up? I know we talk a lot about Xero, but Xero doesn't quite have, there's some third party tools like,
yeah, Xero's got a cash flow manager, or I forget what they call it. It's like their small business insights, where they tell you in the app a 7 or a 30-day cash flow. But you can add on tools like that are a little more robust. Like Xero does have, it connects, it knows what bills you owe. You can also put in like one-time payments that you see coming that aren't in the software yet. But yeah, if you want a cash flow tool, there are plenty on the market.
Gotcha. So that must be new, because I don't remember Xero having, or maybe it's just never been on my radar that Xero had any kind of
let me pull it up. I'm going to tell you what it's called. But yeah, it's and it's actually pretty nice. It's where you can, like I told you, you can somewhat manipulate it. It knows what your bills are. It knows what the AR, like, so in Xero, if you, and lots of software do this, it has what's called expected dates. So you can go in your AR, your invoices outstanding, and say, hey, I expect that's going to get paid on this day and that day. You can also say when I'm planning to pay my accounts payable. So that's going into the cash flow forecast, kind of like you used to do at your small business, just kind of a back of the envelope. Hey, this is what our cash is. We're going to pay these things out. We're going to take in this money. What does that look like in a month?
Yeah. Wow. I wonder if it syncs with like Gusto and
there's literally the tool is called. It does. Yeah, it's called the tool is called short-term cash flow. Okay. And let me see here.
Well, yeah, that sounds like the best place to start. If it syncs up with your, even your like office expenses that you pay monthly and stuff.
Yeah, I'm wondering if it's going to be driven by accounts payable. So if you don't put things in the bills section, then I don't think it's going to know about that. But you could edit the projection. I think this is enough to get you going. But you could manage this in Xero and add like, hey, I'm going to spend X amount of dollars in the next few days and that sort of thing. So this is a good enough tool to get you going.
Yeah, what are the implications of that if you put like small little monthly invoices in your bill bill payment on Xero? Would that be a big hassle?
No, it's not. I mean, the only thing is like we talked about in the bookkeeping episode a couple episodes ago is like you just got to remember
it's another thing to match.
Yeah, you got to then pay the bills. And what I mean by that is apply payments to the bills, not just when they funnel in from the bank feed, just say that's office expense. You know what I mean? And that's the problem.
But you can match it from the bank feed though.
Sure can. Yep. Yeah. And in fact, if it's the same amount, which it would be, it is pretty easy. It's going to suggest it to you.
Yeah.
Yeah.
Huh. That might be worth the setup time to do that then, if it gives you also the benefit of like matching your cash flow.
Okay, so this is pretty cool. I've got here in my cash flow, I did not know this because I hadn't looked at it in Xero in a while. It has expenses. I wish I could show you this. It says monthly prediction, and it's got expenses that it's seen me pay. It's like I've got a texting service. It's like, hey, tomorrow for $109, this is coming out. We think it is. So this is better than the last.
Out of Xero. This wasn't available when I first started using
No,
Xero.
This is even better. I'm ashamed to say I hadn't looked at this in a while, just because we use other tools for clients.
Yeah.
But Xero's cash flow tool looks a lot better because it's got these things it's predicting. It's also got an invoice in here. It's saying we're going to collect on. It's cool.
Yeah.
Yeah. So, but in essence, it's back to what we started when we talked about what you guys did. You can add lots of zeros to your cash flow projection, but when you boil it down, it's just that. What is my beginning cash? What am I going to collect reasonably? What am I going to pay out? That's it. Now, that number, that net of the two generally is going to be negative if you're losing money, right? I mean, It makes sense. Losing money on a P&L standpoint. And if you borrowed money, it's even worse, right? You can't pay back borrowed money with losses. So just start to get an understanding of, okay, profits versus debt and capital reimbursements. Okay. I got to know I have to have profits to use to pay down debt. And then what does cash flow look like on a 7-day, kind of 2-week, month look? That's probably as far as you need to go in a small business.
Yeah.
Yeah.
Okay. Well, we've kind of covered what you use it for, other than just, peace of mind of knowing that your business is going to keep operating. You can use it to make decisions about debt, and be confident that you can manage the debt that you take on.
Yep.
And then we talked about how to actually do it, whether it's in Xero, or I guess alternatively you can kind of rig up a spreadsheet like we've done in the past, or there's some third-party tools.
Dude, I'm kind of geeking out right now. They did not have this tool either. Sorry, Xero, I hadn't looked at this. I can go and select all the invoices that they think I'm going to collect and say what day I think they're coming in.
Wow.
So if I really want to get this cash flow forecast really nailed, I could select 10 invoices and be like, oh, I think I'm going to collect those on April 25th. And that will then build into my 2-week or my 30-day cash flow projection.
Yeah, I wonder why they stop it at 30 days. It seems like you'd want at least to kind of see a quarter.
What do they have? They have 7 days, 30 days, 60 day, 90 day.
I think you owe the CEO an apology.
This is sad given the fact that I went and met with the CEO like 2 months ago.
I know.
Yeah.
That's why I think
I don't think she listens.
I think that's why you owe an apology.
I think we're safe that the Xero CEO is not listening to this.
Gotcha.
But if it gets shared in their Slack channel.
Yeah.
No, but I would say this. This goes back to the point I'm always making. How great is it that I've got a cash flow predictor built into my software? Like, this is a cloud accounting tool. Okay, so let's think this through. It's pulling in data from multiple places because it's cloud. It's pulling in the bills we know we owe. It's got the AR. It's all up to date. And then it's now starting to learn, because Xero's building AI into this. It's learning, hey, I know I saw Walmart in here. We go to Walmart probably twice a week and we buy like creamer and chips and just different office supplies.
Yeah.
Like coffee.
Nacho cheese Doritos.
Cool Ranch. But it's all in there.
Yeah.
So like it's starting to be like, hey, we know you're probably going to spend this. And even if it's not exactly right, it said $59. It might be 70. It might be 24. The point is it's pretty close and it's already included. I could edit it. So I can't hammer this enough way. Get a cloud-based accounting software with these connected tools, and the software is getting better where you don't even need a third party. I was going to mention third-party cash flow tools. I'm actually starting to look more at Xero now.
Yeah.
And just tell my clients like, hey, if you ever want to do your cash flow, we can do it right here in Xero.
Yeah. And too, obviously, I mean, it goes without saying, I guess, I mean, you just discovered a whole new tool because you've been putting your data in, right? That's
Correct.
What we talked about last time and kind of hit on. That means that first row, right? If you're recording your data well, then you'll get an accurate cash flow. You'll get all these other benefits.
Well, I can leverage now because I've got my foundation is set. We reconcile the bank account. We have our accounting up to speed.
Yeah.
That's not most people are struggling through that.
Yeah.
Get that done. Now we can start to be like, hey, let's look at cash flow. This is pretty cool.
I'm pumped too because I had underestimated Xero's cash flow prediction.
I think you need to repent of that. I heard you were pretty condescending there.
Yeah. What's the CEO's name? I owe her an apology too. Shakinder, I hear my apology. I came in a little hot.
Forgive me for Shakinder for I have sinned.
Yeah, exactly. So, but even this new organization that we've talked about that I've set up with, I've got Melio now, if I'm saying that right. I've got
I think that's right.
Gusto. So I'm trying to use the bill payment feature of Xero to match all of that, and now I don't have to do anything else, and I can leverage it'll point in the cash flow.
Well, you could go in. This is really cool too. You could go into the cash flow in Xero, which is now this is becoming the Xero cash flow episode.
Yeah,
fair enough. You could go in there and say, because you're the guy pulling the trigger on these bills, I know these 10 bills are going to get paid in 4 days. Boom. Literally, and I could do it in bulk. I just did that where I was like, it had bills and it had let me edit them in bulk to say when I said, so it let me put what I was talking about, that expected date, which was one of my beefs with Xero before, is that you couldn't edit the expected date in bulk. Well, you can now. Wow. So you could just go in there and say, I know I'm paying these things in 4 or 5 days, add them. Yeah. So I think that's a really neat feature.
All right. Well, we'll end on that note. Definitely check out Xero. Hopefully you're already on it and you've already got this tool and you can just
and
put
you
it
know about it more than we do.
Exactly. Yeah, you just didn't start a podcast to talk about it.
Right.
So, well, as always, go to Mire.group, check out the other podcast and find helpful tips about cloud accounting there and reach out to Marcus and his firm there as well.
All right, guys. See you next time.